Meantime, a new 2023 price target on the street. Evercore ISI expects the S&P 500 to end the next year at 4150. That's only a 4% gain from today's close. But the path to that seemingly meager gain could be stomach-churning. Julian Emanuel is the man behind this target. He's a senior managing director at Evercore ISI. He joins us here on set. Julian, great to see you.
Great to be here.
One does not like to use the word panic on Wall Street, and yet panic is the word I think that you use when describing what we will see in the first part of the year.
So when you think about 2022, we've had this sort of what I call the lazy river of volatility down. You know, we hit bottom at down 25 and change, and we've rallied back. But there has never been a time where there's been emotion in this market, real, honest-to-goodness emotion. And there is no bear market in history that hasn't had that emotional volatility spike.
You're talking about capitulation, blood on the streets.
That's absolutely, absolutely. And frankly, if you're thinking about it in terms of risk-reward, or if you're thinking about it in terms of the Fed's reaction function, and the Fed's telling you they want unemployment to go to 4.4% to sort of, you know, clear the labor force, you've never not had a recession with those kinds of numbers. So you put that all together, and for us, the narrative would be, let's clear that out in the first half of the year and then get a really high value buying zone where people can you know, put new money to work for the long term, as opposed to this trading back and forth that's been the entire year.
What is a catalyst for that panic? And I ask you that because the markets are acting like the Fed is under control. We know what the Fed is going to do. They're probably going to do 50, and then they're going to pause and like let it rest for a little while. So what causes, or do we see a massive reset on earnings? I mean, are we going to see unemployment tick drastically higher in the first half of the year?
Well, we certainly are going to see the reset on earnings. We've seen that. It's going to happen. Our suspicion is when we get to this next earnings season, the market's ability to slough off the downgrades that we saw in both the July and the October month is going to be less because it's, you know, new year, and there'll be really more uncertainty. What it really is just getting closer to that recession. This is the kind of thing that actually happened in 2000 and 2001. You burst the bubble, you had a rally back, but the recession was still a year in the offing, and so the market held up. And then once the recession became crystallized in people's minds, frankly, the most bullish thing this market has going for it is the fact that everyone knows there's going to be a recession. And Carter brought this up earlier, is that my fellow competitors have an average price target of 4,000. That's what we used to call, when I was on the buy side, a short squeeze in the making.
And I have seen a lot of these calls here, right? Whereas the first half of the year, it's going to be a difficult year. But where do you see that in the year? Is this going to be after the new year? Are we still going to have a few more months of this where we're hoping the Fed is going to get us to the soft landing, and then we're going to see this in the spring? I mean, do you guys have an idea of when in the year you're going to see that?
So we're thinking it's a mid-year type of occasion, that basically you could get the market sort of churn for a couple months, discounting the fact that we know the Fed's going to slow. But again, these are all things we know. And when it comes down to is just a more near approach to when that recession is going to start. And then what happens is the degree of any downturn is dependent on the severity of the recession. We don't think the recession is going to be that severe, really sort of in concert with Ed Hyman calling for 0% GDP for the full year 23. That implies a mild recession, but enough given sort of the psychology, the risk-averse psychology, the competitiveness of cash, which most investors have no frame of reference over the last 15 years. That's the recipe.
It feels like you're making your job a lot more complicated, Julian, because you're basically calling for a first half and then a second half. And so I'm going to ask you what your price target is for the first half when we hit that panic.
Two bites on the cherry.
I also want to know what the rally back is going to be like on the other side.
So we think that in the first half of the year, either the S&P 500 or one of the other indices will challenge or take out the lows made in October. That's sort of the clearing event from a price action. And interestingly enough, and Carter, I'm sure as the technical guy, you would endorse this. This year has been unique in that price action has said more than anything, more than fundamentals, more than news, more than anything. Otherwise, how would you have had that reversal on October 13th in an absolutely horrible inflation number? And so for us, basically, the price action is what we'll be looking for to find that clearing event with one or more of the indices taking out those October lows.
So October lows then to 4150.
And look, again, you could overshoot because the other thing that we found is that when the markets rebound, the ability to go to a higher multiple is mind-bogglingly rapid because the sentiment changes very quickly.
Julian, great to see you. Thanks for coming by.
Thank you.
What do you think? He said you would endorse it. Do you?
Yeah, well, there's a lot to consider. I think one thing to think about is exactly a year ago at this time, same circumstance where we're all thinking about the year ahead, strategists are putting out their targets, but 1 out of 2 stocks in the S&P 500 was already down 20%. The market was collapsing in December, even though we were going on to make new highs on Jan 4. So the internals, and the question is, are the internals improving now? To some extent they are, but watch for that, right, where there's divergence between the index and the constituents.
As painful as it's been to kind of wait out this period where people want to have those clearing moments, and by the way, Julian talked about, a VIX that hit 35 multiple times in 2022, but that was not the cathartic moment. And I think, you have different timelines for what a inflation-inspired bear market should mean in terms of a timeline, and it tends to run longer. The most important thing for investors, though, is we are getting to a place where you can be investors again, and it's probably going to come somewhere in the first or second quarter. Part of this has been we've all been waiting for that guidance from CEOs to talk about a world without supply chain, a world without COVID pull forward, a world where we have some inflation actually starting to abate. So I think that's the good news for investors. And whatever that number is, these are the questions both I deal with my investors all the time, but also what I think we get collectively on this desk is when is it time to step back in and actually just, because people who watch this show and watch CNBC and invest in markets love markets and they love investing in companies. The good news is that the Fed will have cleared. The things that are going to be hanging out there that you don't know and they come from slower growth are the credit environment that is often the scariest part of everything we ever talk about on this show. But I do think, based upon Julian's timeline, that's a timeline you really step back in full time. In the meantime, this has been one of the greatest trading markets of all time.
Yeah, 2023 will finally get normalization to some extent in terms of the business conditions.
I hope so. It's interesting if you think about November of last year, the Fed started to tell you, that's it, we're going to turn. If I had told you the expectation would they be 5 or north, that would have seemed quite extraordinary, probably, right? And somehow we've weathered it through, not, definitely battered, but not down for the count. So I don't know. I'd like to see some normalization, but I also think that some of the heyday, those super growthy numbers are not coming back.
Right. The pandemic highs.
The pandemic highs and the,
earnings,
the no earnings, but huge multiple.